if this continues to play out in the way that we think and the trend continues, there is no reason global GDP can't double in a year and even double in a week. And this is what I think gets us out of the debt trap. This is the whole idea of this exponential age thesis that I've got, is this nexus of technologies all hitting exponential adoption phase at the same time and kind of interwoven with each other, drive a productivity miracle, far and away larger than the one observed in the 1950s and 60s, which also got us out of the debt trap then, the post-war debt trap. Very similar situation. And it took us a while, a bit of yield curve control plus new technology. This time around, we might get yield curve control, but the new technology is really going to change everything.
Raoul Pal, a prominent macro analyst and key figure in the digital assets space, challenges the prevailing macroeconomic narrative with his contrarian views. While many voices paint a bleak picture of the global economy, particularly concerning the rapid debasement of fiat currencies and the impending collapse of the financial system, Pal, a former Goldman Sachs executive, diverges from this consensus. Instead of succumbing to the prevailing gloom, Pal sees a way out for the global economy through a simple solution addressing two critical aspects: productivity and demographics. In the face of constant warnings from sound money advocates about the unsustainability of the fiscal path, Pal remains optimistic. Despite the United States' daunting debt-to-GDP ratio of nearly 130% and a substantial budget deficit nearing $2 trillion, he believes there is a viable way forward. Pal suggests that the stagnant development of productivity and demographics in the developed world over the past decade has hindered the ability to take on more debt, a necessary step for global economic progress. In a recent macro discussion on Steno research, Pal shared his outlook on the world's macro situation, offering a unique and fresh perspective on the challenges and opportunities ahead.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
I think people are confusing current economic conditions with the recession that they desperately want versus the markets discounting it, the forward-looking stuff like crypto and tech discounting it in 2022. They all had raging bear markets. Right now, we've got the Russell 2000, oil, copper, all of these things in present-day slow economic conditions. Do we get a full recession or not? Doesn't really matter. It was priced in the stuff that I care about. But the forward-looking stuff, all of the forward-looking indicators from ISM are all pointing firmly higher. So we're around the trough of the cycle. Doesn't mean inflation picks up from here. In fact, because inflation's so lagging because of owner equivalent rents and wages, that it should continue to deflate all of 2024, particularly at the core level. And the headline level, we think, continues to fall. So, we're still of the camp that headline inflation probably gets to zero next year and core inflation too, which I don't think anybody's prepared for because everybody's on the sticky inflation camp. Now, let's worry about inflation in the next business cycle when it heats up, not at the beginning of the business cycle. That's the macro summer, spring to summer transition is generally falling inflation, rising growth. And that's what we're seeing. All the forward-looking stuff is clearly macro spring into macro summer.
This is not a late cycle dynamic, is it?
No, this is early cycle. It's exactly as it should be. So we've had the ISM troughing, all the forward-looking indicators pointing up. The business cycle dominoes mean that the things that the Fed look at, inflation and unemployment, are the last shoes to drop, which is why they've been very slow on this cycle. So what they will see is unemployment rising somewhat. Nobody expects a massive rise in unemployment, but a bit stickier. And I think AI and stuff like that will make it stickier. I don't think most of the jobs lost in Silicon Valley are coming back. So people have to reorganize themselves and to find different work and stuff like that. And then inflation, I think, continues lower for, at least next year. And then it'll start picking up again, as all business cycles do. And I don't know where the story that it's the 1970s all over again comes from, because I don't see it anywhere in the data. Of course, inflation will pick up next time. Of course, the year-on-year effects will make it look stronger. So we will get a rebound in inflation. But the reality is if you think that wage earners have the power versus a world of AI and robotics, I mean, that's a different world. This is not the 1970s of your parents.
Numerous compelling instances support Raoul Pal's thesis that increased productivity and economic expansion can alleviate the burden of debt, allowing for the continuation of kicking the can down the road through periodic money printing. One illustrative example frequently cited by macro analysts like Powell and Len Alden is the role of globalization in the early 1980s. At that time, when the United States faced a significant national debt, globalization efforts, driven by technological advances facilitating international transactions, played a crucial role in mitigating the economic challenges. The adoption of China's open-door policy and the overall global interconnectedness of the 1980s and 1990s allowed the U.S. to postpone addressing its debt concerns for another 4 decades. The 1980s and 1990s marked an era of globalization, as recognized by the International Monetary Fund, and these developments significantly influenced international economic dynamics. Fast-forwarding to the present, Raoul Pal anticipates that if the potential of the artificial intelligence revolution aligns with his optimistic projections, there may be another extended period of economic development, potentially lasting 40 or 50 years. This foresight suggests the possibility of sidestepping the dire predictions of economic downturns that many have been forecasting. Returning to Pal's interview, his insights provide valuable perspectives on navigating the complexities of macroeconomic challenges and opportunities.
And every business I speak to is now starting to utilize AI. And that means that they will hire less. Doesn't mean they lay off people necessarily, but they'll hire less in the business cycle, which is fine because unemployment's pretty low right now anyway. And we've seen that kind of behavior in Japan. Unemployment stays low regardless of the cycle because the labor force shrinks, and the labor force shrinks in the US for the same reasons, demographics. But really how you need to frame AI is, okay, GDP growth or trend rate of GDP is driven by population growth plus productivity growth plus debt growth. Now, debt growth stopped in 2008. All debt growth now is really servicing of old debts. It's the ongoing repayments of debt cycle. Productivity growth and population growth in all the developed world has been falling, which is why trend rate of GDP has been falling. So trend rate of GDP has gone from, the early 90s of 3% down to 1.75 now. So it's been falling because of demographics. But now you introduce workers or new productive units into the labor force, which is AI and robots, at infinite scale. If I look forwards, I only see an increase in AI and an increase in robots. We're seeing that in every factory around the world of the robots. And when robots have AI, they become even more productive. So this now mimics humans because you're infinite scaling of knowledge and applied knowledge. So therefore, it kind of solves the population problem. This is one of the reasons why China is talking so strongly about robotics as a core part of their future, particularly humanoid robots, is because they don't have the population growth. But this is a big answer. And when you do that, you start increasing productivity because productivity was dragged lower from demographics. The other part of productivity is the lowering of energy costs. Basically, electricity prices across the world have underperformed inflation. They've been relatively steady, except last year, obviously. So it's been steady. I looked at UK inflation prices for the last 50 years, electricity prices for the last 50 years earlier this morning, and they've been flat for a long time. But as we introduce more renewables, as we introduce cheaper renewables, there's a exponential downwards in cost in this stuff. It's just you can't do enough of it and you can't store enough of it. But as technology improves, the overall cost of electricity will come down. And so therefore, productivity is really the output per kilojoule of energy at a core first principles basis. So if your unit of energy cost goes down by half, it doubles your productivity. And then you add the AI, the robots, and AR, VR, genetic sciences, all of these things on top, and you get a miracle, an economic miracle. Now, that's not going to happen this cycle, but we'll start to see the seeds of it. But really after the next cycle, by the time we get to 2030, it becomes almost impossible to predict what economies look like. There's a group at Oxford University where Nick Bostrom, who's one of the thought leaders on all of AI, and where a lot of the work came from, there's an economist involved in that group that says, listen, if this continues to play out in the way that we think, and the trend continues, there is no reason global GDP can't double in a year and even double in a week. And I get it. It's directionally right.
Yeah.
But it won't be now. But that's what's coming. This is what I think gets us out of the debt trap. This is the whole idea of this exponential age thesis that I've got, is this nexus of technologies all hitting exponential adoption phase at the same time, and kind of interwoven with each other, drive a productivity miracle, far and away larger than the one observed in the 1950s and 60s, which also got us out of the debt trap then, the post-war debt trap. Very similar situation. And it took us a while, a bit of yield curve control plus new technology. This time around, we might get yield curve control, but the new technology is really going to change everything.
According to Powell, there remains a significant chance, even at this juncture, for continued smooth sailing without severe repercussions for Americans and other nations with robust currencies. Nonetheless, he underscores the importance of investing as a vital and obligatory strategy for those seeking to preserve and grow their wealth over time. Despite this, traditional asset classes like bonds may struggle to keep pace with inflation. Mainstream stock indexes, such as the S&P, can help maintain wealth but may not necessarily contribute to its growth. In Powell's view, cryptocurrencies stand out as the top choice, alongside technology stocks, as the only assets expected to consistently outperform currency debasement. Powell's perspective prompts a reflection on the role of artificial intelligence and rapidly advancing technological innovations in addressing the world's substantial debt challenges. He suggests that embracing these innovations could potentially offer a solution. If you've watched the video, Powell invites you to share your thoughts on whether you agree with his viewpoint. Do you believe that AI and other swiftly evolving technologies hold the key to resolving the global debt crisis? Feel free to share your comments, observations, and opinions in the comment section below. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.